Hello viewers, welcome to my channel. Today we are discussing very sensitive and important topic about our investment wherein we compare risk versus return, which instrument is better, and we are taking two safe instruments. One is bank fixed deposit, another is SIP of the stock market. So keep watching till the end and you will have a lot of information. This is in the format of a tutorial. If you work for a salary or save money in India, you probably think about this question every month. A lot of people are wondering if they should put their money in SIPs to grow it or keep it in safe and fixed deposit. You are probably at a crossroads that is hard to understand. On the one hand, the Indian stock markets have grown up with SIP inflows reaching all-time high. But the boring old fixed deposit has suddenly become interesting again, not just because of interest rates, but also because of a quiet change in the economy known as this. This picture explains how it's growing. The real returns on safer assets have gone up a lot since CPI inflation dropped to about 1.7 to 2% in late 2025 and early 2026. Changes to the capital gains tax, on the other hand, have hurt your mutual fund profits. With the cost of living going up, job markets being unstable, and inflation slowly eating away at savings, picking the right investment vehicle is no longer a choice, it's a must. Why should you put your money in fixed deposits in 20? For a long time, financial experts called FDs losing money to inflation. But that story seems to be technically wrong in 2026. The real return has come back. Let's see how. Now, inflation is around 2%, and small finance banks are paying around 8 to 8.6% as interest. This means that your real return minus inflation, is a healthy 6%. This is great, and it's not something that happens very often in history. In the past, 6% inflation often ate up 7% FD rates, leaving you with nothing. The gap is your profit today. The interest rates right now, if you observe, public sector banks like SBI, they pay about 6.25 to 7%. And private banks like HDFC, ICICI, they pay 6.5 to 7.2. And small finance banks like Unity, Jana, they are paying about 8 to 8.6%. Of course, for the seniors, 5.5 is more in all these places. You can see the effective interest rates between different types of investments in this. Now let's talk of our main subject today, that is what is fixed deposit. A fixed deposit is a bank investment in which you put money in for a set amount of time and earn interest on that. Let's understand SIP. SIP stands for Systematic Investment Plan. SIP lets you put a set of amount of money into mutual funds, usually equity funds, on a regular basis to build your wealth over time. You're putting your money every month, say 500 rupees or more. Returns that are likely to come linked to the market, and they give you the power of compounding. The power of compounding gives you more return as the time passes off. It's called time value of money. The bottom line is that FD keeps money safe, SIP makes money grow. Please keep in mind that diversified equity funds still give 12 to 15% annualized returns over 5-year periods, even though the market is volatile. Mid-cap and small-cap funds have bigger rallies, but they are also risky. As per new tax regime, the long-term capital gains, if you sell after 1 year, profits over 1.25 lakhs are taxed at 12.5%. Earlier it was 10%. The short-term capital gains is if you sell within a year, you pay 20% tax on your profits. You might be wondering why SIPs still win. Because equity taxes are much lower than 30% slab rate for FDs, even with 12.5% tax. Try this with a profit of 1 lakh rupees. You pay 30% tax. You pay 30,000 rupees in taxes if you are in the FD bracket of 30%. You can go through this example for the net. In SIP, you pay nothing if you are within 1.25 lakh exemption limit, or you pay 12.5% on. For wealth creation, we will see between SIP and FD. In this example, you can see investing 5,000 rupees every month for 20 years, the returns in FD as well as in SIP. SIP can make more than twice as much money over. FDs are great when you need to keep your money safe and you are putting money aside for a short-term goal that is for less than 3 years and it is for some emergency purpose. When you are retiring, you don't like taking risks. For example, you require fund for medical emergencies or down payment on a house in 2 years or tuition fee payments. SIPs are better when you want to invest for 5 years or more, build a retirement fund, plan for your kids' education, or beat inflation and build wealth. SIPs are good when you are planning for retirement, being financially free, building wealth over time. When to choose FD over SIP? Middle class investors often make these mistakes, putting all their savings in FDs, not investing in stocks because they are afraid, stopping SIPs when the market goes down, or investing without goals. These need to be investment preferences for different age groups is given in this. Just being safe won't make you rich. The strategic verdict is stop thinking either or that could be bad. In 2026, the smart investor will use a mix of strategies based on how the economy is doing right now. Scenario A, the safety first investor, 45 years old or older, someone who doesn't want to take risk. Invest 60% of the money in FDs and 40% in SIPs. Why? You take advantage of the rare high rates, real rates of FDs to protect your capital while letting a smaller part of your investment grow in stocks. India is a growing market, so you benefit from the growth. Don't let market fluctuations get you down. Don't let market fluctuations get you. Scenario B, the wealth builder, 25 to 40 years old, willing to take risks. In that case, put 20% of your money into FDs only for emergencies and the balance 80% into SIPs. Why? Taxes, not market volatility, are your biggest enemy. If you pay 30% tax on FD interest, your wealth goes down. For long-term compounding, the 12.5% capital gains on SIPs is much smaller. If you are still in the old tax regime, you can save money on taxes under Section 80C by using ELSS mutual funds. What is a smart move? Use both. In such case, financial planners say you should take a balanced approach. Step 1. Make things safe. Put enough money in an FD or liquid fund to cover 6 months worth of. Step 2. Build wealth. Use SIP to invest for the long term. Step 3. Change with age. More SIP for younger investors. In the summary checklist, the number one is check your tax situation. If you are in a new tax regime, tax saving FDs with 5-year lock in won't help you save money on taxes. Stick with debt funds or liquid funds. Point number two, look for lower rates. Don't just renew your FDs at big banks which are paying peanuts. Check out small finance bank that offer 8% or more. Look over your SIPs because LTCG tax rate has gone up to 12.5%. You should not buy or sell funds too often. You should shuffle less. Buy and hold helps you avoid. The fourth one, the inflation advantage. Keep in mind that a 7% return is actually very good when inflation is around 2%. Don't hate the humble FD this year. It's doing a lot of work to keep things stable. In the last thought, let me tell you, in 2026, FDs are for keeping your buying power and SIPs are for growing it. The middle class winner is not the one who chooses the best product. It is the one who chooses the right time frame for the product. This article is only for educational purposes. Before making any financial decision, please talk to a SEBI registered investment advisor. Thank you very much for sparing your time. This is ProVG signing off and thanking you all. Please subscribe to my channel.